Hey everyone, when it comes to money, the stage of life that you are currently in can largely dictate and decide whether risk or uncertainty is your best friend or a thief in the night. Investment options that were great when you're 25, for example, can sink you at the age of 65. So to be an age-appropriate investor, what we need to do is we need to go to the future, scrape some of that wisdom off of our future self, and apply it to the person that we are today. Now, if you don't know me, my name is Darcy Ungaro. I am a financial advisor who works with everyday people of all sorts, prepping for and entering into the best years of their life. On this channel, though, I talk about all things property and investing, and I apply it in the New Zealand context. So please subscribe if you like hearing this sort of thing, and give this one a like on the way through. So to be an age-appropriate investor, we need to learn when it's okay to accept risk or uncertainty of outcome. When you're young, time can be like a tailwind. It's not just about letting your riskier bets compound, though. It's about some breathing room so that you can learn and recover when you make mistakes or when the market or life throws you a curveball. When you're older, though, time, instead of being a tailwind, becomes like a brick wall. A mistake with money can actually carry a lot more bite, especially when it's finite and you're trying to make it last. Time isn't on your side like you were when you were younger, so you can't just sit back and wait for markets to recover if you've overextended yourself into something that didn't pay off the way you thought it would. And this is a really, really common problem that a lot of investors have. We like to think that we know exactly how the future is going to pan out. However, in almost every situation that I've seen, the situation doesn't in fact pan out the way people thought. Sometimes it's better, sometimes it's worse. So we have to kind of think about this from the point of view of, if we make a mistake, in the unlikely event that we make a mistake, will we have enough runway to make it up? So this is the idea that volatility or uncertainty around your investment returns is acceptable when you're able to hold the investment for a long time horizon. Risky assets like shares in individual companies and Bitcoin swing wildly in price in the short term. They're very volatile. It's a bumpy ride. But these can also pay off over the long term because the sum of all of the price rises over time can often be greater than the sum of all the price declines. Volatility is a characteristic or side effect of high growth investments. Now, the first area that I want to break this down in is in the area of property, specifically your first property move. Property tends to perform well over time in New Zealand and in a lot of Western countries like the UK, Australia, Canada, and the US in particular. The long-term annual house price growth rate is more or less around 6% over the last 30 years. Now, this means that a $750,000 home that you could buy right now could be worth around $6 million in 35 years' time. Massive. Why this is a big deal is that should your first move with property not be the best move that you're capable of making, the difference can really add up over time. So if instead you bought a $1 million home, that $6 million can turn into $8 million. So just a $250,000 price difference today can stretch to become $2 million tomorrow. So stretching yourself instead with a bigger home as your first move, when you're young and your income is still growing, isn't just bravado, it's actually mathematically strategic. The bigger and the earlier you go, the more you capture those gains that can accrue over time. Playing it too safe and buying a smaller or cheaper home often just means that you're going to pay more later on, not just in property price increases, but in bigger mortgages and lifestyle compromises. The real kicker is that this often happens when kids come along and when you're down on one income. The grown-up life can catch up pretty quick. And when my wife and I bought our very first home, we made this mistake ourselves. We played it too safe. We could have paid a little bit more to buy the home across the fence, but the size of the mortgage that would be required scared us at the time. And the irony, once kids arrived and we started spending big on nappies, we faced the reality we'd be spending big shortly on property too. We needed a larger home, and the mortgage required to service it was about to become larger. It would have been better if we made that bigger move first. Here's what I learned. Going larger, sooner, can help avoid tomorrow's higher price tag. Over time, inflation, which can cause our income to rise, can make our mortgage feel smaller than it does when we're starting out. It's human nature, though, to take less risk when there's a knowledge gap or when the environment feels a little bit uncertain. Like, take the property market right now in New Zealand. Who really wants to catch a falling knife, right? But this could be possibly, hopefully, one of the best times to take ground. And this is why almost no one actually follows the advice to go big early and pay off the mortgage later. Most freak out. Most wait until the property market is already at its peak and they are definitely left behind before they jump in along with everybody else. Now, investing isn't just all about property, although, let's be honest, a lot of New Zealanders in particular think it is all about property. But let's talk about Kiwi Saver. That's the next cab off the rank or the next drug of choice to access if you're thinking about building more diversified wealth or money in more buckets. The two biggest financial puzzles we will be solving in our lives, and our kids will as well, are buying that first home and funding that retirement. With Kiwi Saver, I don't think we need to overthink it. We should start early. Yes, we shouldn't worry about whether there's government incentives or all that sort of stuff. If you are parents of small children, I am talking to you here. Sign them up. Crank up the risk settings to growth. Remember, the best time to acquire investments that are likely to perform well is when you have a long time period to hold it. It's that whole relationship between uncertainty and time horizons. But in the context of KiwiSaver, what is growth? Simply put, most KiwiSaver plans comprise of two different investment types being made at the same time. Growth style investments are often shares in companies. These can offer uncertain returns because the environment that these companies operate in can be uncertain, and their performance in this environment can be uncertain also. But over time, these companies can offer the best returns. The other component that your KiwiSaver fund might be investing in is called income assets, also known as fixed interest or bonds. While these investments don't increase in value much, if any, they pay what's called a yield or an income. Growth can be volatile, yet capable of growth. But income, while it's a little bit more boring, can often provide that steady stream of returns. It's the classic hare and the tortoise example, right? Either way, you do get there in the end, but blending these two styles can balance uncertainty and returns. When you're young, it should really be this simple. Because you can endure more uncertainty, you should have your KiwiSaver invested into more shares and less bonds, more growth and less income, more volatility, and yes, but with time, the odds of getting a strong return are stacked in your favor, and less certainty. It's appropriate, therefore, when you're younger and you have a long time horizon in front of you to accept the volatility, because we know that the odds of getting a strong return are stacked in your favor over time. So consider the mathematics of it all as well. Just $300 a month starting right now could turn into around $200,000 in 30 years' time. So parents, again, if you want to help your kid into the property market, KiwiSaver. Simple. Now, so far, I have focused on situations in which more risk rather than less risk is the most age-appropriate thing to do as an investor. Here are two situations, though, where less risk is the best risk. If you're about 5 years away from buying your first home, or you're drawing near to retirement and expecting to draw down from your savings soon, it's time to begin reducing your investment risk. We want to get things out of growth and more into income the closer we are to spending that money. And this applies to the young and the old alike, not just based on their age, but based on situations coming up in the future. So for KiwiSaver, this means shifting out of growth funds and moving into balanced or even conservative funds. This way, less of your KiwiSaver will be exposed to shares and more will be exposed to income assets, which often include these bonds. Now, I know it's not that sexy, but it's the best way to ensure that your house deposit doesn't shrink in size right before it's called upon. Usually, at least 5 years from your intended withdrawal date, it's recommended that you start reducing this risk. Remember, it's not just always about your age, it's about the milestones that you have coming up. This exact same principle applies for those that are nearing retirement. Your withdrawal time frame, not just your age, is what really matters. It's not about avoiding risk completely, it's just about managing that risk realistically. So sometimes time is your ally, other times it's the size of your investment account that's your biggest asset. Age appropriate investing means that you don't make decisions that are too conservative or too risky at the worst possible times. It's knowing when to lean into uncertainty and when to pull back. Buy the bigger home, pay the mortgage off later, maximum risk for Kiwi Saver, ride out the uncertainty, and who knows, you just might get wealthy on the other side of all this. Now, I hope you enjoyed all that, and if you did, please be sure to subscribe, hit that notification bell so you're aware of when I release the next one. Take care, we'll see you in the next one.